Okay, let's dive right into this data-driven explainer where we are going to unpack the absolute masterclass in market manipulation and whale accumulation that we've just witnessed. Welcome back, everyone. Today we're cutting right through the mainstream noise to deliver some pure, unadulterated market alpha. Look, if you're a retail investor trying to navigate these incredibly choppy waters, you really need to understand something. While the broader retail crowd has been sweating bullets over macro fears lately, the apex predators of the blockchain, yeah, they've completely flipped the script. We aren't just looking at random spot-driven retail pumps here. No, we're analyzing a calculated, surgically executed squeeze that caught the majority of the market totally offsides. So lock in, because we're going to unpack exactly how you can decode and trade this massive volatility spike.
So here's our roadmap for today's explainer. We're going to kick things off with the whale awakening, compare retail versus smart money, break down the liquidation engine, analyze some shifting macro battlegrounds, and finally wrap up with strategy, specifically looking at options and custody.
All right, Section 1, the whale awakening. Let's start by looking at the monumental fundamental catalyst that violently shattered Bitcoin's $61,000 ceiling. The board has been flashing green, sure, but underneath the surface, the data tells this fascinating story of aggressive rotation and hidden whale tactics. You thought corporate accumulation was a thing of the past? Well, think again. Corporate accumulation is back, and I mean back in a massive way. MetaPlanet aggressively dropped a $170 million market buy. They scooped up an astonishing 2,823 Bitcoin. As an investor, you really have to realize that when a corporate entity of this sheer size executes a market buy of that magnitude, it sends an immediate shockwave straight through the order books. This isn't some slow trickle, right? It's a fundamental catalyst that acts like a spark in a powder keg. And the follow-through on-chain? It's historic. The blockchain literally never lies, and the data we're seeing right now is nothing short of unprecedented. Right at the $59,000 level, whales hoovered up 270,000 Bitcoin, creating an instant illiquid supply shock. I just want to let that number sink in for a second. 270,000. That is the largest single accumulation spike ever recorded on-chain in this specific price cluster. When those coins are yanked off the active market and tucked securely away into cold storage, the circulating supply dries up instantly. So any subsequent demand hits an illiquid market, forcing the price to gap up aggressively just to find willing sellers.
Moving on to Section 2, retail versus smart money. Now, there is a staggering, and I mean staggering, disconnect between the media's narrative and actual on-chain reality. Here's where the situation gets incredibly fascinating, especially for newer retail investors who are just trying to figure out who to listen to. We're witnessing a massive divergence between retail ETF flows and high net worth on-chain behavior. Back in June, US spot Bitcoin ETFs experienced a record $4.06 billion in outflows. Naturally, the mainstream media took this data and ran wild with a bearish narrative, absolutely terrifying the casual retail investor. Retail was panicking, capitulating, and dumping their bags at a loss. But over that exact same 2-week period, wares quietly bought $16.7 billion worth of Bitcoin. The smart money used the mainstream media-induced panic over those ETF outflows as a literal smokescreen. They capitalized on that fear to build their positions at a massive discount. So, if you were only looking at the ETF data, you were incredibly bearish. But if you were looking at the on-chain reality, you were aggressively longing the bottom. This is the exact kind of information asymmetry you absolutely must learn to exploit.
Okay, Section 3, the liquidation engine. This information asymmetry we just talked about, it provided the perfect environment for a massive forced volatility spike. Let's break down how this builds into a textbook short squeeze, where retail's overleveraged bets were weaponized by institutional algorithms to create a total cascade of forced buying. Here's the anatomy of it. Step 1. Retail traders getting spooked by those ETF outflows pile into low timeframe short positions. Step 2. They place their tight stop losses just above the $60,000 psychological level. Then, Step 3 is where the trap snaps shut. The $57,000 to $59,000 zone was this heavily defended liquidity pool. When whales and MetaPlanet stepped in with huge spot volume, we didn't see a slow, grinding breakdown, we saw an immediate, aggressive V-shaped recovery. Why? Because the market was way overly leveraged to the short side. So when that smart money volume pushed the price directly into those stop losses in Step 4, it triggered a cascading chain reaction of forced buying.
The math on this squeeze is brutal, but man, is it highly educational. $130 million in Bitcoin short positions were forcibly wiped out during that initial pump. When a short gets liquidated, the exchange automatically market buys the underlying asset to cover the position. That creates artificial buying pressure that acts like absolute rocket fuel for the price action.
Across the broader crypto ecosystem, we saw over $606 million in leveraged position liquidations. This right here is exactly why proper risk management and core security practices are non-negotiable for retail investors. If you are over-leveraged during a high volatility accumulation phase, you aren't really trading. You're just stepping up to provide exit liquidity for institutional algorithms.
Now, as risk appetite expands following a squeeze like that, we're also tracking algorithmic capital rotating into high-conviction mid-caps. While the majors were dominating all the headlines, attentive traders were tracking a significant breakout in Zcash, which pushed up 7.4%, alongside a really massive 16.3% rally in Uniswap. Look, these aren't just random fluctuations. As Bitcoin establishes a local bottom and starts grinding higher, institutional risk appetite expands, and that liquidity naturally trickles down into high-conviction mid-caps. Uniswap's surge in particular highlights this renewed interest in decentralized exchange infrastructure. For your weekly strategy, it is all about tracking that algorithmic rotation.
Which brings us to Section 4, Macro Shifts and Battlegrounds.
We can't analyze the crypto market in a vacuum, right? The macro picture is actively shifting right beneath our feet. Currently, traditional Wall Street finance is signaling extreme caution, and they are battling directly against native crypto entities who are out there aggressively deploying capital. Take Citigroup, for example. They just dropped some massive research, slashing their Bitcoin price target down to $82,000 and cutting Ethereum down to $2,240. They're also expecting absolute zero ETF inflows for the immediate future. Now compare that deeply conservative outlook with the aggressive corporate buying we just saw from MetaPlanet. This is the ultimate battleground. Traditional finance is signaling caution due to macro headwinds, while native crypto entities and massive whales are treating these exact same prices as generational buying opportunities.
And this macro tension? It's driving broader capital flows. Right now, speculative investors, what we often call fast money, are aggressively rotating out of Bitcoin and precious metals like gold, and they're moving straight into semiconductor stocks. This shift is a direct response to Federal Reserve rate hike fears and a total breakdown in gold's traditional correlation with real interest rates. When fast money abandons crypto for traditional tech equities, it completely removes a massive layer of speculative buy pressure from the order books. What does that do? It leaves the crypto market highly dependent on organic, long-term accumulation to sustain these higher price levels.
All right, final section. Section 5, Strategy, Options, and Custody.
To trade like a professional in this kind of environment, we have to elevate our game. We do that by tracking aggregate institutional-grade options data and monitoring structural shifts in how assets are actually being held. The days of only looking at spot volume and simple moving averages, those are completely over. But before we look at the specific data, it's vital to understand a concept called put-call skew. This reveals when traders are willing to overpay for insurance against a market crash. If you really want to understand market sentiment, you must understand gamma exposure and volatility metrics. Put-call skew simply measures the cost of downside protection. When traders are heavily buying puts, they're essentially saying to the market, I want to hedge my portfolio against a sudden drop. By tracking these dealer gamma walls, you can literally see where market makers are forced to buy or sell to remain market neutral. That is what gives you a predictive edge.
So let's apply this options data right now. Despite the bullish price action we've been discussing, the Bitcoin one-week put-call skew is currently elevated at 16%. So what does this actually mean? It's telling us that smart money is terrified of a sudden macro rug pull. They're essentially saying, yes, we are definitely enjoying this bounce, but we are absolutely terrified of sudden downside. They are actively paying a heavy premium to hedge their bets. When the put-call skew is this elevated, it signals that the market is inherently fragile and highly sensitive to any negative news catalysts.
Adding to this structural red flag, centralized exchange volumes have fallen to their lowest levels since September. When price goes up, but aggregate volume across both spot and derivatives is trending down, that is a massive structural warning. It means this recent price rally is built on a foundation of sand. It lacks high volume participation from the broader market. So, for retail investors mapping out their weekly strategy, this means you must adjust your position sizing accordingly. High conviction trades require high volume confirmation. Without it, you absolutely must tighten your stop losses and aggressively take profit at predefined resistance zones. Protect your capital.
Now, at the exact same time we see volume dropping, we are tracking a massive on-chain anomaly. Binance just recorded a 3-year high in Ethereum withdrawals in a single day, processing a staggering 166,000 transactions. This signals a monumental, coordinated shift towards self-custody. Users are pulling their assets off centralized platforms and securing them in cold storage. After the traumas of previous exchange collapses, the baseline crypto investor is becoming highly sophisticated regarding counterparty risk. If you are a beginner building a checklist for protecting your personal investment accounts, moving assets off exchanges is a critical step. And structurally, it reduces the liquid supply available for market makers to dump, which dramatically tightens the overall supply mechanics of the network.
And this ties everything together perfectly. MetaPlanet is pioneering the MicroStrategy playbook in the East, suggesting that massive corporate treasuries allocating to Bitcoin will completely dwarf those ETF flows we obsessed over earlier this year. By positioning themselves this way, they're explicitly adopting a treasury reserve asset strategy to hedge against fiat debasement. If this trend catches fire globally, and mid-cap publicly traded companies begin allocating even just 1% of their balance sheets to Bitcoin, the resulting institutional demand vector is going to be unlike anything we've ever seen. Keep your eyes on corporate treasuries. That is the true next frontier.
So I want to leave you with this final thought to consider. With the liquid supply of the market historically constrained by this self-custody supercycle, and whales having just absorbed 270,000 Bitcoin out of nowhere, the macro bull thesis actually becomes incredibly clear. Yes, the market is giving us massive volatility, conflicting data signals, and absolute structural chaos, but the supply side of the equation is historically constrained. So I leave you to consider, how violently will this supply shock react? And what levels will prices melt to the moment global liquidity conditions finally ease and retail demand inevitably returns to the market? Stay sharp, respect your risk management, and keep tracking those data points.